Hello everyone. Today we will discuss the topic insurance. Now, every now and then we have heard this word insurance. Now, through this chapter, we will understand what is insurance and what are the principles or what are we supposed to do while taking insurance. Okay, now let us see. Insurance services aim at providing risk cover to the insured person. Means a person who takes insurance, it means that if there is any uncertainty, then means if anything uncertain thing happens and if we suffer any loss, then if we have insurance, then we can minimize that loss, okay, against unforeseen happening in the future. Insurance is one of the key elements of business activities, and businesses need to get themselves insured against the future happenings. Now we know that future is uncertain. We can't say what will happen in future. If we could have seen our future, then we could have prepared in advance, but since we can't do that in business, because of this uncertainty, sometimes business has to suffer a huge amount of loss. So in order to minimize that loss, insurance is very important for all the business enterprises. Now, misfortunes are part of human life. Mishappenings are always unexpected and sudden. Business as a human activity is also a victim of various and varied risks. In chapter 1, we have learned about various risks. Okay. Now, causes for this risk may be natural, seasonal, geological, physical, economical, and human. Now, we have also studied in chapter 1 that some risk we can avoid by proper preparation, and others we cannot avoid. We have to face those risks. In certain cases, this risk may be shared. You can share those risks with some people, then you can shift or you can divide that risk. Profit motive is the basic requirement and essential characteristics of business, but if any uncertain thing happens and if the business suffers loss, then a business cannot avoid that. The life and property of the business is always at risk. It was therefore desired that there should be certain agency which should be prepared to undertake that risk or compensate for the loss and relieve the psychological pressure of insecurity and uncertainty of the future. Now, this desire was fulfilled and the objective achieved by taking insurance policies. Insurance policies, they only cover pure risk, means those risks which can be insured. There are some other risks which we cannot cover, which are not covered by insurance company. They are known as uninsurable risk. For instance, consumers indifference, market competition, change in technique, style, etc. If any business enterprise suffer loss due to this kind of changes, like change in the style or change in preference of customer, then they cannot insure those kind of losses. Okay, now let us see some difference between insurable and uninsurable risk. When we talk about nature, insurable risks are recoverable, means you can insure those kind of risks, and if you suffer loss, then insurance company will help you. Okay, but there are some but uninsurable risk, they are not recoverable. Then causes. Insurable risks are the results of natural calamities such as fire, floods, accident, etc. But uninsurable risks, they are caused due to the change in the market conditions, change in technique, fashion, etc. Then some examples are given for insurable risks, like loss of property due to fire, floods, loss of life due to accident. And example of uninsurable risk are change in fashion, change in government policy, market competition, etc. Now, when we talk about present scenario or present condition of insurance in the country, we can say that insurance is very much needed by all sector of the economy, that is primary, secondary, and tertiary, because India is a developing country and all the three sectors of the country are developing. They are fastest growing. Okay? They are fastly growing in the country. So it is, it is very much needed by each and every sector to get insured. Okay, now earlier when insurance was introduced in India in December 1999, the services was provided by the government. Okay, but from 2000 IRDA they started granting licenses. Means nowadays we can see lots of private companies providing insurance services. That was enabled by IRDA from year 2000. Nowadays we can see lots of companies like Bajaj, Allianz, Tata, AIG, ICICI, Lombard, Aviva, etc. They all are providing insurance facilities. They are nothing but private enterprises providing insurance facilities. And in government sector, LIC is the most famous, or you can say the most dominating insurance company. Okay, now let us see what are the characteristics of insurance. When we talk about insurance, it is nothing but a contract. A contract is nothing but an agreement between two parties. Okay, now first characteristics of insurance contract is an agreement enforceable by law. Insurance contracts are made under the provisions of Indian Contract Act 1872, as there must be offer and acceptance. Now it is an insurance contract is nothing but an agreement which is enforced by law, and to make that kind of agreement or contract there are some characteristics, or you can say features. Okay, features of contract are applied in this insurance as well. That means there must be offer and acceptance. Means in this kind of contract, the insurance company, they are providing offer to help you in case of your damage, and you are accepting that offer. And then contractual capacity of the parties, means both the parties, that is insurance company as well as the person who is trying to take insurance services from that company, both of them, they should be capable of entering into a contract. Means they should not be of minor age, they should not be of unsound mind, then they should not be barred by the government to enter into a contract, or in another word you can say they should not be criminal. Okay, then there should be free consent. Means both the party, they should enter into this kind of contract by their own will, they should not be forced by someone else. And then lawful consideration. Now as we all know, in insurance what is done is that the person who is taking insurance from the company, he used to pay insurance premium, and after some time or after some unfortunate thing happens, the insurance company, they compensate the person. Okay, so in both the cases, whatever the amount of money they are giving or receiving, it should not be of illegal related. Okay, the consideration should be, or you can say the objective of the contract should be a legal one and not an illegal one. Otherwise that contract will not be a valid contract. Then next is competent two parties. Insurance contracts are agreement though, so there must be at least two parties. The one party is known as insurer, means the company who is giving you this facility will be known as insurer, and the person who is taking that facility, suppose if I go to an insurance company, then that company will be insurer and me, I will be the insured. Okay, I will be known as insured. The insured must be competent to enter into contract. That means I should be able to enter the contract. Means my age should be more than 18, I should be of sound mental condition, then I should not be disqualified, or that means I should not be a criminal. Okay, the next is premium. The insured has to pay premium on his insurance policies as consideration against the risk undertaken by the insurance company. That means since I am insured, I I'm supposed to pay premium on a particular interval, okay, on a particular time to the insurance company, because the company is taking risk of certain things of mine. Insurance contract is enforced from the date of the payment of insurance premium. As soon as I make the first insurance premium payment, that contract will be enforced. It is an essential requirement of the contract that the insured must pay the amount of the premium as per agreement on specified dates. If I'm not able to pay that premium on specified dates, then the contract will be treated as means I have breached the contract, means I'm not fulfilling the condition of contract, and in that case our contract will get cancelled. Okay, it will get repudiated. Then next is contract of indemnity. The insurance company assures the insured that if the insured property, suppose if I go to an insurance company and I have insured my house property, then etc. suffers loss, the insurance company will compensate for the loss as per the agreement policy. Means the house property which I have insured, if it suffers any loss, then the company or the insurance company will compensate me. That means they will pay me the amount of loss that I have suffered related with my house property. That is known as contract of indemnity. Means indemnity means to compensate. Okay, remember that. The next feature or characteristic is utmost good faith. Means both the insurance company as well as insured person, they should remain faithful towards each other. That means they should not hide any material information regarding the insurance. Okay, that means I on my part, I should reveal all the related information regarding my house property which I have taken insurance for, and the company as well, they should give me all the information that I'm supposed to know about the policy. Okay, material information are those facts whose knowledge would have affected the agreement regarding the insurance. Means I am going to insure my house property, so I am supposed to give all the facts, knowledge, or all the information related with my house property which can affect the agreement between me and the insurance company. Okay, so these were the characteristics of insurance contract. Then it means that it is an agreement which is enforceable by law. There should be competent two parties, then there will be premium, then it is a contract of indemnity, means contract of compensating loss, and there should be utmost good faith from both the parties. Now there is one more term related with insurance, and that is assurance. So we have to understand what is meant by assurance. It refers to a contract under which the sum assured is bound to be paid sooner or later. It is quite different from insurance, because in case of insurance, compensation is made on damages due to fire, floods, etc. Means insurance is nothing but it means to compensate the loss which is caused by fire, flood, or any other reason. Okay, but in case of assurance, the amount is paid either on maturity of policy or damages or loss, example life insurance. Now assurance on the other hand means that the amount will be paid to you eventually if there is loss or if there is no loss also. Means insurance means if there is loss, then they are going to compensate you, but assurance means whether there is damage or loss or not, you will receive the money. Okay, therefore in insurance, compensation is paid only on happening of an event. Means until and unless the damage is caused to you, you will not get the money in insurance. But in assurance, whether any uncertainty happens or not, you will receive your money. Okay, ordinarily both these two words, insurance and assurance, are interchangeably used. The glaring example is the name of life insurance company, though technically it should use the word assurance. In life insurance corporation, what happens is that if you take any LIC, then you are supposed to pay premium, okay, for a particular period of time for which you have taken insurance, and within that period, if you die, then your family member, they will receive money. But if you don't die within that particular period of time, then ultimately on the maturity of that period, you will receive your money back. So this is the difference between assurance and insurance. Although assurance and insurance are different, but these days everything is used in insurance. Assurance, we hardly hear its name. Okay, now what are the functions of insurance? Insurance provides protection, it helps in risk sharing, it helps in capital formation, and it provides certainty. Now let us see the functions of insurance. First one is protection. Insurance provides protection from probable chances of loss. Insurance cannot eliminate the chances of mishappenings. Means if you take insurance, it doesn't mean that you won't suffer loss, okay? Or it doesn't mean that since you have taken insurance, I will not suffer, nothing bad will happen with my business. It is not like that. Something bad may happen to your business, but insurance is there to protect you from that mishappening or loss. How? By compensating for the losses. The next is risk sharing. In case of insured mishappening, the aggrieved policyholder is compensated by the insurance company. Suppose if you have taken insurance for your business, and if there was a fire in your godown and you have suffered some loss, so what the company will do is that the insurance company, they will pay you the amount equivalent to the loss you have suffered. Now what they do is that they give you money out of the money which they have collected from other insured policy holders, okay? So it is also known, means you can also say that you are sharing your risk with other policy holders, because the insurance company, they have taken money from other policy holders and then they have compensated you, okay? The next is assisting capital formation. Premiums collected from innumerable policy holders by the insurance company constitute huge funds which is used in various income generating activities. The funds raised are invested in productive activities. Now all the amount that they have received from policyholders through premium, what they do is that they used to invest in other generating activities. Who knows, they might purchase shares, or they might lend those fund as loan to someone else, okay? So insurance also helps in capital formation. Then next is providing certainty. The insurance removes uncertainties. The insured is assured of being compensated for the loss suffered by him. It enables the insured to go ahead with the effective plans for the future. Means through insurance, you can carry on your business according to your plans without even taking tension of loss, because insurance company is there to compensate you. So it helps in providing certainty, means regularity in your business, okay? Then there are some principles of insurance. So in this session we will discuss principle number 1 and 2, principle of utmost good faith and principle of insurable interest. Now according to the first principle, that is principle of utmost good faith or uberrimate fide, it means that both the insurer and insured must disclose all the material facts and information to each other, okay? It is similar to one of the features of insurance contract, that both the parties, they should be honest with each other. They should disclose, or they should provide each other with the relevant information or material facts which they should No. Okay. Then concealment means hiding of the material fact will make the contract voidable, means ultimately the contract will be cancelled or get cancelled at the discretion of the aggrieved party. Now let us see one example. The insured is a cancer patient but does not disclose this material fact in his proposal form. If the insured dies of cancer, the insurance company is not liable to pay the insurance money because the insured person, he did not give information about his cancer. He knew that he is ultimately going to die, but still he hide that information and he took the insurance. So in that case, the insurance company, they are not liable to pay the money. In case of fire insurance, if certain flammable material like petrol is stored in the godown, okay, it must be intimated to the insurance company, means it should be informed to the insurance company that he had kept some flammable material like petrol in his godown. But if this fact is concealed and the godown catches fire, the insurance company will not be liable to compensate for damages because the company, they didn't knew about the petrol being stored there in the godown. So the insurance company, they will say that you didn't tell us about that petrol, and since it was your fault, you hide that information from us, then we are not liable to pay you any money. Okay. Then next is principle of insurable interest. It is the basic and essential requirement of an insurance contract that the person taking the insurance policy must have personal and direct insurable interest in the insured person or property. The person is said to have insurable interest when he stands to gain with the safe existence of the insured person or property. Now earlier I took example of my house property. Now let me take one more. Let me take that similar example. If suppose I had insured my house property, then it means that the insured material or insured property, that is my house property, I should have an insurable interest on that property. Means if there is any damage to the property, then I should be able to suffer that loss. Means it should mean that it is my loss as well. Okay, until unless I don't gain anything from the safe existence of that property, or damage to that property means damage to me, I cannot insure any particular thing. Okay, so it means, in other words, it means that the goods that or the thing that you are going to get insurance for, it should gain you in its safe existence. Mean whenever that is in safe existence, it is in good condition, it should be able to give me any gains. Or if it gets damaged, then it should give loss to me. Okay, because of that I should suffer loss. The objective behind this principle is that the insured should be compensated for the loss. The loss will be suffered by the insured if his own personal property is destroyed. He cannot be said to have suffered loss due to destruction of the property of someone else. Okay, if my neighbor's house gets damaged, then I will be feeling emotionally sad, but it doesn't mean that I will suffer loss. So until unless a particular thing is related with me, or damage of that particular thing gives me loss, I cannot insure that property. A person has insurable interest in his own life but not in the life of his neighbor. He has insurable interest in his own house but not his neighbor's house. It is just possible that the person may be emotionally attached with the neighbor and feel it as his own personal loss. It should be taken as granted that the insurance company will compensate for the actual and real loss, not for the emotions and feelings. Remember that the insurance company, they go for actual and real cause. They don't think about emotions and feelings. If someone mortgages his property and borrows money worth rupees 5 lakh, he has an insurable interest in the property to the extent of 5 lakh. So there are some insurable interests in case of fire insurance policy and marine insurance policy. In case of fire insurance policy, the owner of the goods, he has insurable interest in his own goods. Owner of the property will have in his own property. Agent will have insurable interest in the goods of the principal, because he is working as an agent for the principal and it is his duty to keep those goods safe. Okay, then if a person trusts someone with his goods, then the trustee will have his insurable interest in goods. Then pledger in the pledged goods, partner in the assets of the firm will have insurable interest. Then in case of marine insurance policy, the owner of goods will have insurable interest in his own goods. Then owner of the ship will have insurable interest in his own ship. The receiver of the rent will be concerned with his own rent. Then captain and employees of the ship will have insurable interest in their salaries. Then travelers, they will have insurable interest in their goods. In life insurance, there must be insurable interest at the time of taking insurance contract. In marine insurance, it must exist at the time of loss of the subject matter. Means life insurance, when we take life insurance, we take insurable interest in our life while taking the insurance contract. But in marine insurance, it exists at the time if the subject matter is lost, then at that time the owner will have insurable interest. And in case of fire insurance, insurable interest will both be present at the time of making the contract as well as at the time of loss of the subject matter. So these were the first two principles of insurance. Tomorrow in next session we will discuss about the remaining 4 principles of insurance. Okay, for this session we will wind up here. Thank you.